Hey, it's Max from UNFTR for the MeidasTouch Network. You can catch me on Blue Sky and YouTube at UNFTR. Now, today we're doing a shallow dive into the U.S. economy and the really scary thought that these are the guys that are leading us through what is shaping up to be a potential disaster in the financial markets. So if you've caught my videos on Meidas before, you know that I normally take my time with these kind of analyses, but something happened literally this week in the markets that warrants our immediate attention. And it's something that we've been warning about here on Meidas for a while, so I will keep it brief, but you gotta hear it. We're talking about, well, cockroaches and repo. Let's go. The phrase asleep at the switch refers to trains heading toward one another on the same track. Now, the switch operator is hopefully awake and pulls the switch to divert one of the trains to the other track. Now, should that operator be asleep, then, well, you get the collision. And right now, the public financial system, which is the Fed and the Treasury, is on a collision course with the private banking system, and it's unclear if anyone is even operating the switch, let alone if they're awake. So we'll address the cockroaches thing first to set the table. Like E.F. Hutton in the old commercials, when Jamie Dimon speaks, everyone listens. Now, I'm not one of those hang my hat on everything that Lord Dimon has to say, because he's the master of mixed signals himself. This wouldn't be the first time that he signaled one thing while the banks were doing another. But considering JP Morgan Chase is the biggest bank in the United States with around $4.5 trillion in assets, it's worth a listen. So as much as it pains me to throw them into this, here's Fox Business News to introduce what Dimon said that got tongues wagging on Wall Street.
JP Morgan CEO Jamie Dimon issued a warning on the earnings call Tuesday. He said, quote, "I probably shouldn't say this." Okay, but of course Jamie said it, because that's Jamie. "But when you see one cockroach, there are probably more." Dimon was referring to the bankruptcies recently of the auto dealer Tricolor Holdings and auto parts conglomerate First Brands Group.
Okay, so let's unpack this before I show you what broke in the financial markets this week, because it will help contextualize things. As you saw in this clip, there were two very high-profile bankruptcies recently that raised eyebrows on Wall Street. The first was a subprime lender called Tricolor, and the other was a manufacturing company with a private credit arm called First Brands Group. Now, in the latter's bankruptcy proceedings, it was disclosed that as much as $1.9 billion provided by lenders had simply gone missing. Just poof! Lawyers on both sides are still looking for it. In fact, it's become somewhat of a meme on Wall Street. So the question is whether these were isolated incidents as the result of fraud, or an indication of something more systemic, i.e., if you see a cockroach, that means that there's more hiding somewhere. Now, these events also happened in close proximity, so concern has begun to spread that there might be an issue in the private credit lending industry. So, first off, we need to distinguish between private credit markets and the traditional banking system. Essentially, commercial banks are extremely transparent these days. The reporting and the capital reserve requirements are so stringent that we all have a very clear picture of their activity. This covers commercial real estate, business lending, lines of credit, home mortgages, you name it. It's all very safe and very well underwritten, at least the visible ones. But since the Dodd-Frank regulations implemented after the financial crisis, banks have also supplied capital to private corporations like hedge funds, venture capital firms, investment banks, and private credit lending firms. And this is where the term off-balance sheet comes in. Banks are lending in bulk to other lenders who then put that money out to counterparties at higher rates. So these are massive lines of credit and facilities that, as long as they're receiving regular interest payments, there's an assumption of general health. The only problem is that we can't see the individual loans and portfolios in the private side of the ledger. All we can see is whether they are customers of the more transparent banks. Okay, so let's use Wells Fargo as an example. Let's say Wells Fargo has a healthy lending relationship with another giant firm like Blackstone or Apollo. These are themselves extremely well-capitalized companies. So even if, let's say, 5% of their lending portfolio is under duress, which would be a lot, they could probably still manage it, meaning they could make their payments back to Wells Fargo. So we wouldn't know whether there was a problem there. But below that giant level, there are also mid-market and subprime market lenders that are themselves pretty big, and they've staked out really risky positions in commercial lending. So let's say one of them is called MeidasMax Capital, or MMC, and I run MMC, and I have a line of credit and a facility at multiple high-profile banks that list me as a client, like Wells Fargo. And I get money from them at 5.5%. I turn it around, and I loan those funds out to hundreds, maybe thousands of businesses, to other auto finance companies or landlords, whatever. Only my rates are anywhere from 9 to 15%. So if a handful of these loans run into trouble, I can work with the borrowers to maybe repackage them, maybe give them interest only for a while, or PIK loans, which is what we talked about in our last video, where I let them stop paying interest for a while in return for more equity in their companies. So I can manage this so long as the others are still paying. And so I can afford to keep up my payments to Wells Fargo and the other banks that I get the money from. So when you look at the big transparent banking sector, on the surface, everything looks hunky-dory, like it did in 2008. But then all of a sudden, like in 2008, if a few of my bigger bets go south out there, then suddenly I might have trouble with my Wells Fargo loan, which is one isolated loan to Wells Fargo, but it might represent hundreds to me. So in this scenario, I'm the cockroach. And now for the possible collision. So thinking globally now, the money that's in the banking system comes from the Federal Reserve. That's how the world works, right? The Fed prints the money and loans that money to banks at a favorable rate so that the banks are well capitalized. Now, in turn, those banks like Wells Fargo lend this money out into the world and earn the difference. So in our scenario, the Fed loans money to the banks who loan money to MeidasMax Capital, who loans money to the public. There's a lot of hands on this cash. Now, importantly, the banks will also use this money to purchase treasuries from the government at a set interest rate. So they always have a nice buffer, meaning they'll invest in the government and the government will still pay them back more money than they invested, right? Every so often, though, the broader market becomes illiquid, meaning there's more money in loans that have to be settled out than the banks have in cash. And so things get a little tight. And in these instances, the Federal Reserve will supply additional money by either printing additional banknotes and buying securities from the banks, in other words, replacing assets with cash, or by releasing money from a rainy day fund called the Standing Repo Facility. And here's the problem. The Standing Repo Facility, the rainy day fund, at the Fed is empty. The money has been depleted because the Fed has had to purchase treasuries to fill the U.S. Treasury account. Why? Because we have to fund the government, and the deficits are growing wider and wider because we refuse to tax the wealthy and the corporations in this country. But now for the scary part. At the end of each fiscal quarter, U.S. corporations move a ton of money around to try and clean up their books for quarterly reporting. And twice a year, they sell a bunch of securities to pay taxes. So during these very predictable times, the Fed will pump liquidity to make sure everyone can buy and sell whatever they need to get their banks, to get their books set for the end of the quarter or to pay taxes. But on 3 separate occasions this year, prior to this month, it hasn't been enough. And so they've had to step in to inject more money than they anticipated into the system. So if you look at these spikes before October, these all fall on quarter end days. And I want to stress that even though these events are happening more frequently, this alone does not necessarily cause alarm because the Fed always has the money. And then something broke in just the last couple of days. Those last 2 spikes on the chart. The Federal Reserve had to step in after quarter end, twice, once on October 15 and then again on October 16. So here's the thing. The markets never, ever need money after tax days and quarter end. Okay, that's a lie. The only time it's happened in recent memory is COVID. We can't even look at the global financial crisis because a lot of these backstops were created in the wake of it and because of it. So this is an entirely new way that the Fed has to intervene in the markets. But outside of COVID and these quarter-end days, the market doesn't need this kind of liquidity. And it's unsettling because it means that the private credit market is possibly running really tight on money. So back to that switch that we were talking about. When things like this happen, there isn't a person at the switch. A whole crew is called in. The heads of the Treasury, the Federal Reserve, the Senate Banking Committee, the White House, and the nation's largest banks, who are also members of the Fed. This is the moment that they should be assembling like the Avengers to assess the damage to the private credit market. Only government oversight can compel these private companies to open their books so that we can stress test this very important but shadow banking sector. Otherwise, we're in the dark. And right now, the Fed chair is under fire from the president. The head of the Treasury is actively running an effort to replace that guy. The president's totally out of touch with everything, and the government is shut down. And the big banks, not for nothing, these are the same asshats that destroyed the financial system less than 15 years ago. Now, this is just one sliver of the entire banking system, and I want to reiterate one thing, that if the market does explode, the banks will be fine. This is not like last time. It's not like the global financial crisis. It's different. I mean, banks are still sitting on just under $3 trillion in cash and marketable securities, and the Fed will happily backstop them by converting things like mortgage-backed securities and treasuries to cash. Essentially, they'll swap it out. They'll pay them cash to take that stuff and put it on their own balance sheet. But the private credit market exposes something more raw and fundamental about the economy. I mean, we know that inflation is going over 3%, and it's probably there already, even though oil is trading below 60, and that's an important component of it. And when they release the next jobs data, it's going to be ugly. It's one of the reasons the GOP doesn't care if the government stays closed forever. Truly. I mean, we've covered that before as well. See, the economy is bleeding out from the bottom. And for all their fancy terminology and their talk on the financial channels and repo markets and reverse repo markets and credit spreads and all that, it's Dimon's cockroach statement that probably says it all. Where there's one, there's many. Where there's smoke, there's fire. So we're going to keep an eye on these markets for everyone and just keep breaking it down. But I really thought this was important to get out there because they can't hide from this much longer. Because the backdrop to all of this, of course, is that China just dropped an economic bomb on us by giving Donald Trump a taste of his own medicine with the rare earth export controls and restrictions. I mean, this is bad. These Trump tariffs are the worst example of overplaying a hand we've probably ever seen. We're so not prepared for this battle with the Chinese government right now, but that's for another day. For now, just know that these markets are in trouble. I don't think that these are isolated incidents. When we look at those bankruptcies, they want to say that it's the result of fraud and they're just one-offs. This is 2008 speak all over again, and there's nobody minding the store. So we got to keep an eye on it. So for now, thanks again to the Meidas Mighty for having me here. I'm Max from UNFTR. Make sure you follow us on YouTube at UNFTR and connect with me on Blue Sky. I'll see you in the next one.
Love this video? Support independent media and unlock exclusive content, ad-free videos, and custom emojis by becoming a paid member of our YouTube channel today. You can also gift memberships to others. Let's keep growing together.